There's a story unfolding right now that nobody's talking about, but it might be the most important financial development you'll witness in your lifetime. Banks across America are quietly being stripped of their ability to sell physical silver to retail customers. Not because they don't want to, not because there's no demand, because regulators are systematically cutting off access to the one asset that could protect ordinary people when the monetary system breaks down. While everyone's distracted by stock market highs and cryptocurrency rallies, a silent war is being fought over silver, and the window for ordinary investors to acquire physical silver at current prices is closing faster than anyone realizes. We're not talking about paper silver, ETFs, or digital certificates. We're talking about actual metal you can hold in your hands, the kind that's been money for 5,000 years, the kind that central banks can't print more of when they need to fund their next crisis. Here's what's happening behind closed doors. Major banks that used to sell silver coins and bars directly to customers are receiving new compliance directives. These directives don't explicitly ban silver sales, but they make the regulatory burden so complex and costly that banks are walking away from the precious metals business entirely. It's death by 1,000 regulatory cuts, and it's happening systematically across the financial sector. Chase stopped selling precious metals to retail customers in 2022. Bank of America followed in early 2023. Wells Fargo quietly discontinued their precious metals program last year. One by one, the largest financial institutions in America are exiting the physical silver market, leaving ordinary investors with fewer and fewer options to acquire real metal. But here's where it gets interesting. While banks are being pushed out of silver sales, their own internal trading desks are accumulating physical silver at unprecedented levels. The same institutions that can't sell you a silver eagle are buying thousands of ounces for their own accounts. This isn't coincidence. This is strategy. The people making these decisions understand something the general public doesn't. They know what's coming. They know that when the next financial crisis hits, when currencies start failing, when confidence in digital assets evaporates, people will rush toward the one thing that's maintained value through every economic collapse in history: physical silver. And they're positioning themselves to own it before everyone else realizes what's happening. The regulatory squeeze isn't random either. It's part of a coordinated effort to control access to alternative forms of money. Central banks around the world are preparing to launch digital currencies, programmable money that can be tracked, controlled, and confiscated at will. But physical silver represents something they can't control. It's anonymous, portable, and impossible to debase through monetary policy. It's everything digital currency isn't. That's why access is being restricted now, while most people aren't paying attention. By the time the average investor realizes they need physical silver, the infrastructure to buy it will have been dismantled. The banks won't sell it. The dealers will have waiting lists. And the price will reflect true scarcity instead of paper manipulation. Let me show you exactly how this manipulation works, because understanding this is crucial to seeing why we're approaching a historic opportunity. The silver market operates on two levels. There's the paper market, where contracts representing millions of ounces trade electronically every day. And there's the physical market, where actual metal changes hands. These two markets are supposed to track each other, but they've been diverging dramatically. On the paper side, silver futures contracts worth more than 10 times annual global production trade daily on the COMEX. Banks and hedge funds short these contracts to suppress the price, creating artificial abundance where real scarcity exists. It's a shell game where the same few thousand ounces of physical silver in COMEX warehouses back contracts for millions of ounces of paper claims. But in the physical market, shortages are becoming impossible to hide. Coin dealers are reporting delivery delays of 8 to 12 weeks for standard products. Premiums over spot price have tripled in the past 2 years. And industrial users are building strategic stockpiles because they can't guarantee future supply at any price. This disconnect between paper and physical is creating the setup for what precious metals experts call a supply squeeze. When enough people demand delivery, of actual metal instead of paper promises, the system breaks. And when it breaks, the price doesn't just rise, it explodes. We've seen this before in smaller markets. In 2021, a group of retail investors on Reddit attempted to squeeze the silver market by buying physical silver and forcing delivery on futures contracts. The effort was partially successful, driving premiums to historic highs and creating temporary shortages. But it was small scale, disorganized, and easily contained by increasing paper short positions. What's different now is the scale and coordination of the forces building pressure. It's not just retail investors anymore. Sovereign wealth funds are accumulating silver. Industrial companies are building strategic reserves. And most importantly, the Eastern nations that actually produce silver are keeping more of it instead of shipping it to Western markets. China, the world's largest silver producer, has been quietly reducing exports while increasing domestic consumption. Russia has essentially stopped silver exports to Western markets entirely. Peru and Mexico, major producers, are implementing policies that prioritize domestic silver demand over international sales. The global supply chains that Western markets depend on are being restructured to serve different masters. Meanwhile, demand is accelerating from sectors that can't substitute other materials. Solar panel production requires silver for electrical conductivity. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure deployment is creating massive new industrial demand. And none of these industries can function without physical silver, not paper contracts. The math is becoming impossible to ignore. Annual silver production is roughly 800 million ounces. Industrial demand alone consumes about 600 million ounces. Investment demand, jewelry, and government purchases account for most of the remainder. There's virtually no surplus production available to meet increased demand from any source, but the paper markets continue operating as if supply were unlimited. Futures contracts representing billions of ounces trade daily, creating artificial liquidity that keeps prices suppressed. It's the financial equivalent of selling tickets to a concert in a venue that doesn't exist. Eventually, the people with tickets show up expecting seats. That moment is approaching faster than most people realize. The signs are visible if you know where to look. Premiums for physical silver have been rising steadily, while spot prices remain relatively stable. This means the real cost of acquiring silver is increasing, even though the quoted price suggests otherwise. It's a preview of what happens when paper and physical markets completely disconnect. Coin dealers are struggling to maintain inventory despite record sales. The US Mint has been rationing Silver Eagle production due to blank shortages. Private mints are operating at maximum capacity but can't keep up with demand. These are the early stages of a supply crisis that will eventually force price discovery back to reality. The window for acquiring silver at current prices won't stay open much longer. Not because silver itself is disappearing, but because access to it is being systematically restricted. Banks are stepping away from retail sales. Regulations are making it harder for dealers to operate. And the infrastructure that allows ordinary investors to buy physical silver is being quietly dismantled. When the window closes completely, silver won't become unavailable. It'll just become unaffordable for most people. The price will reflect true scarcity instead of paper manipulation. And the people who recognized what was happening while there was still time will find themselves holding one of the few assets that maintains value when everything else fails. This isn't a prediction about some distant future crisis. The mechanisms are already in motion. The regulatory restrictions are already being implemented. The supply shortages are already developing. And the disconnect between paper and physical markets is already widening toward the breaking point that will reshape precious metals forever. The forces driving this transformation extend far beyond simple supply and demand economics. What we're witnessing is a deliberate restructuring of how precious metals flow through the global financial system. Central banks and government agencies have spent decades building mechanisms to control asset prices through paper markets, derivatives, and regulatory frameworks. Silver represents the last major commodity where this control structure is vulnerable to disruption. Consider the timing of these regulatory changes. They're not happening during a crisis when emergency measures might be justified. They're happening during a period of relative economic stability, when most people aren't paying attention to precious metals markets. This is strategic positioning, not reactive policy. The infrastructure for silver access is being dismantled while demand remains manageable, ensuring that when demand spikes, supply channels will already be constrained. The regulatory burden being placed on the silver dealers provides insight into the broader strategy. New compliance requirements mandate extensive record keeping, customer verification processes, and reporting standards that make small-scale silver sales economically unviable. Dealers who once sold silver coins over the counter now require background checks, waiting periods, and documentation that rivals mortgage applications. The metal hasn't become illegal, but acquiring it has become bureaucratically prohibitive for casual investors. This regulatory maze serves multiple purposes. First, it discourages impulse purchases by casual investors who might otherwise buy silver during market uncertainty. Second, it creates a paper trail for every transaction, eliminating the anonymity that makes precious metals attractive as alternative money. Third, it increases costs for dealers, forcing smaller operations out of business and concentrating silver sales among a few large firms that can be more easily controlled or regulated. The parallels to other historical asset restrictions are unmistakable. In 1933, Executive Order 6102 required American citizens to surrender gold to the Federal Reserve in exchange for paper dollars. The order didn't ban gold ownership entirely, but it made private gold ownership so difficult and legally risky that compliance became the only practical option. Today's silver restrictions follow a similar pattern, using regulatory complexity instead of outright prohibition to achieve the same result. But there's a crucial difference between the 1930s gold confiscation and today's silver restrictions. In 1933, the government needed gold to back currency under the gold standard. Today's restrictions aren't about backing currency, they're about preventing alternatives to currency. Central banks are preparing to launch digital currencies that can be programmed, tracked, and controlled in real time. Physical silver represents an escape route from this financial surveillance system. Digital currencies offer governments unprecedented control over economic behavior. Transactions can be monitored, restricted, or reversed based on government policy. Savings can be subject to negative interest rates that force spending, and access to money can be tied to social credit scores or compliance with government directives. It's a level of financial control that makes traditional banking look primitive by comparison. Physical silver undermines this control structure because it operates outside digital systems entirely. You can't program silver. You can't track silver transactions remotely. You can't impose negative interest rates on metal sitting in a safe. And you can't confiscate silver without physical access to where it's stored. These characteristics make silver incompatible with the financial surveillance state being constructed through digital currency systems. The industrial demand story for silver is equally compelling and often overlooked by investors focused on monetary applications. Silver possesses unique properties that make it irreplaceable in numerous high-tech applications. It has the highest electrical and thermal conductivity of any metal, making it essential for electronics, solar panels, and electrical systems. As the world transitions toward renewable energy and electric vehicles, industrial silver demand is accelerating at unprecedented rates. Solar panel production alone could consume the entire global silver surplus within the next 5 years. Each solar panel requires approximately 1 ounce of silver for electrical connections that can't be made with substitute materials. As governments mandate renewable energy transitions, solar panel demand is becoming non-negotiable regardless of silver prices. industrial users will pay whatever is necessary to secure silver supply, creating a price floor that investment demand builds upon. Electric vehicle production is adding another massive source of industrial demand. Electric cars use approximately 3 times more silver than traditional vehicles due to electrical systems, battery connections, and charging infrastructure. As electric vehicle adoption accelerates globally, automotive silver demand is projected to triple by 2030. This isn't speculative investment demand that can disappear during market downturns. This is industrial consumption that permanently removes silver from available supply. The supply side of the equation reveals equally compelling dynamics. Most silver production comes as a byproduct of copper, lead, and zinc mining operations. When base metal prices decline or mining operations become unprofitable, silver production falls regardless of silver prices. This creates supply inelasticity, where silver production can't respond quickly to price signals. Unlike gold, where dedicated mines can increase production when prices rise, silver supply is largely dependent on industrial metals mining that operates on different economic calculations. Recent geopolitical developments have further constrained silver supply channels. Russia and Belarus, significant silver producers, are effectively cut off from Western markets due to sanctions. China has been reducing silver exports while increasing domestic consumption for industrial applications. Mexico and Peru are implementing policies that prioritize domestic silver demand over international sales. The globalized supply chains that once ensured steady silver availability to Western markets are fragmenting along geopolitical lines. Meanwhile, above-ground silver inventories are at historic lows relative to annual consumption. Unlike gold, which accumulates in central bank vaults and private collections, silver gets consumed in industrial applications and doesn't return to available supply. Decades of industrial consumption have depleted above-ground silver stockpiles to levels that provide little buffer against supply disruptions or demand spikes. When shortage conditions develop, there's no strategic reserve to stabilize markets. The manipulation of silver prices through paper markets has created artificial abundance that masks these fundamental supply constraints. Futures markets allow banks to create unlimited paper silver through short positions that don't require physical metal backing. This synthetic supply keeps prices suppressed while real silver becomes increasingly scarce. But paper manipulation only works as long as investors accept paper claims instead of demanding physical delivery. Recent stress tests of this system have revealed dangerous vulnerabilities. During the 2021 Reddit silver squeeze, relatively modest physical buying pressure caused widespread delivery delays and premium spikes. The system barely contained a disorganized retail buying campaign. A coordinated effort by institutional investors or sovereign wealth funds could overwhelm paper market defenses entirely. When that happens, price discovery will shift from paper markets to physical availability, and current price levels will seem absurdly low in retrospect. The window for acquiring silver at manipulated prices is closing because the manipulation mechanisms themselves are becoming unstable. Paper market control requires confidence that physical delivery won't be demanded in significant quantities. But growing awareness of supply constraints and monetary system vulnerabilities is driving more investors toward physical metal instead of paper promises. Each investor who chooses physical delivery over paper exposure weakens the manipulation structure that has kept silver prices artificially low. Banking restrictions on silver sales represent the final phase of access control before the system reaches its breaking point. Once retail access is eliminated, only institutional investors and wealthy individuals will have practical ability to acquire significant silver positions. By the time ordinary investors recognize the opportunity, the infrastructure for participation will have been systematically dismantled, leaving them as observers rather than participants in the greatest precious metals revaluation in modern history. The evidence is overwhelming. The regulatory squeeze is tightening. the supply chains are fragmenting, and the manipulation mechanisms that have kept silver affordable are breaking down in real time. We're watching the final stages of a transformation that will reshape precious metals markets forever. The banks understand what's coming. That's why they're accumulating silver while making it harder for you to do the same. The regulators understand what's coming. That's why they're building barriers around silver access while digital currencies are still in development. And the industrial users understand what's coming. That's why they're stockpiling metal regardless of current prices. The $100 silver window isn't just closing because of supply and demand fundamentals. It's closing because the entire system that has kept silver prices suppressed is being deliberately dismantled from the inside. When that system breaks, and it will break, the price won't just double or triple. It will explode to levels that reflect decades of artificial suppression. This isn't about predicting the future. This is about recognizing what's already happening while there's still time to act. The mechanisms are in motion, the access is being restricted, and the window for ordinary investors to position themselves is measured in months, not years. History will mark this moment as the last opportunity to acquire real money at paper prices. The question isn't whether silver will reach $100 an ounce. The question is whether you'll have any when it does.